We have both good and bad market news, and depending on your position, you might make or lose a lot of money. Here's an example. In this video, we'll discuss a subject you may not have considered: a reverse market crash. Prices rise swiftly, allowing some to become affluent while others fall behind. Survivor tech stocks rose 10,000% after the 2011 dot-com bubble. Investors bought foreclosures during the 2008 mortgage crisis, and in 2020 before asset prices quadrupled or tripled. Because most people miss these record-breaking reverse crashes, let's talk about what's going on, what to look out for, the biggest mistakes people make, and why the next decade could bring once-in-a-lifetime opportunities. Let's get started. To begin, this is a vicious cycle in which the rich get richer while the poor get poorer. After all, the middle class is fast dwindling. Middle-class wealth has declined by about 50%, while upper-class income has increased by nearly 30%. According to the same survey, median household wealth has failed to recover following the 2008 financial crisis, with the average American family having a lower net worth in 2016 than in 1998. Furthermore, according to a recent study, the U.S. middle class has shrunk from 61% in 1971 to 50% in 2021. Since March of last year, the average wealth of the middle 40% has fallen by 7% or 27,000, one of the most significant drops since the 2008 financial crisis. Let's look at why this is happening, mostly because wealthy people have more resources to save and invest. When interest rates fall or inflation rises, their investments gain value. This explains why the richest 1% make so much more than the rest of us. What does a reverse stock market crash entail, and how could you avoid falling behind? The reasons for these reversal crashes are similar. Consider Germany in 1914. Each German mark was worth $1 or 25 cents. However, Germany was defeated in World War I. War damages cost them a lot of money and harmed their economy. To address this, they printed a large amount of money. They produced so much money that $1 equaled 1 trillion marks. Consider this. In 1919, a student purchased 2 coffees from a cafe. Each cup was priced at 5,000 marks on the menu. He was handed a bill for 14,000 marks. To save money, he was encouraged to order both cups at the same time. Let's look at Zimbabwe. Despite being remarkable for producing a $100 trillion note, they were only worth 40 cents in the United States. How did this happen? Zimbabwe's administration bungled things, spending a lot of money on military and food while laying out how much money they printed. Every month they printed $20 million more than was required. They prohibited inflation. This destroyed trust in Zimbabwe's currency, causing prices to rise across the board. What about another one? Argentina is one of them. Argentina's inflation rate just reached 142%. If you thought that was awful, consider that inflation has averaged 206% per year since 1950. First, they've defaulted on their national debt about a dozen times. They made so much money that the Argentine peso has lost 99% of its value versus the US currency in 10 years. Currency depreciation decreases economic investment and affects outcomes. Since 2020, severe currency depreciations have increased their stock market by 165%. Turkey and Iran are 2 more examples of when inflation reached over 50% and stock values increased. Finally, Venezuela experienced rising inflation and a reverse stock market meltdown. According to all accounts, the same thing is happening in the United States. So, before we respond, please like and subscribe. Consider whether this could happen in the United States. Consider nominal and real interest rates to better comprehend this. I promise it's easy. Interest rates, like Fed rates, are nominal. They have an impact on mortgage rates, savings account earnings, and bond returns. Assume the Fed declares 5.25% interest, the nominal interest rate. This is the ruse. This is not the entire story. Inflation has an impact on these rates. The real inflation rate is obtained by subtracting inflation from the nominal rate. You receive a more precise cost estimate. Despite today's high interest rates, inflation-adjusted rates have been quite low during the last 2 decades. I'll show you how. Real interest rates in April 2001 were 2.2%. Following the 2008 financial crisis, real rates fell below 0, making borrowing profitable. During the 2020 shutdown, real rates fell to 0.5%. Thus, you earned $5,000 for every $1 million borrowed. That's strange. What does this have to do with a reversal of the market? Zimbabwe, Argentina, Turkey, and Iran have all had economic difficulties with negative interest rates in the past. They borrowed and printed a lot of money back then. The government regulated pricing. But as we can see, citizens lost faith in the economy. Here's my opinion on whether this is a cause for concern. First, several individuals interpret this graph on middle-class contraction differently. According to Brookings, the middle class is not going away, it's only getting better. Following government transfers, health insurance, and household size reductions, the bottom one-fifth of the income distribution had 25% more income in 2007 than in 1979. They also discovered that the middle fifth increased by 37% during that period, and that government programs and help have made the middle class far better off today than they were in the 1970s. According to another survey, the middle class is shrinking as people move into higher income brackets. Although it may be difficult to accept, these facts are true. Between 1971 and 2021, the middle class decreased dramatically, giving way to the upper class. People with low incomes improved, but not as much as those with higher incomes. The United States has the lowest middle class among comparable countries, but the most prosperous and impoverished classes, implying that people are becoming richer or poorer. Even if middle-class wealth is declining, some of the decline can be attributed to people becoming wealthier and creating more money, depending on how the data is interpreted. Second, while rising inflation and stock prices decimated Germany, Zimbabwe, Argentina, Turkey, Venezuela, and Iran in the 1920s, consider the United States. Germany's market expanded by 600% in 3 years. Their market, however, dropped by roughly 80% versus the US dollar, wiping out any apparent winnings. Zimbabwe is becoming increasingly extreme. Their market increased by 1,000 to 553,000. However, their market has dropped by more than 90% against the US dollar. Argentina is no different. A major stock market boom once again results in a 61% loss in purchasing power in US dollars. Venezuela, Turkey, and Iran are all in the same boat. In those conditions, high stock prices did not enhance purchasing power. Even if having money for appreciating assets is beneficial, they all lose value in comparison to US cash. Most of the countries were also severely impacted by violence, corruption, famine, and sanctions, all of which hampered rehabilitation. Let's look at the US scenario. We're having problems. The national debt is over $33 trillion, and political parties are split. Prices are rising despite the Fed's desire for them to remain low. However, in the past, prices and borrowing rates were higher. For the past 50 years, our economy has been steady, and the US dollar is a global currency. We cannot predict the next 200 years without problems. However, the United States is not like other countries that have had 200% yearly price increases and a massive stock market boom. There are some significant changes. If that happened here, we'd confront more challenges and place a higher value on firearms, ammunition, and food. But keep in mind that a similar situation in the United States occurred previously. Prices increased, interest rates dropped, and people made or lost a lot of money. That is why I believe wealth disparities extend beyond income. Who can invest and take risks is also important. Investors and people with extra money benefited the most when the Federal Reserve first reduced interest rates and the stock market plummeted. Others lost out, and rising prices diminished the purchasing power of their money. Wealthy investors can handle short-term ups and downs, so they take on more risk in exchange for greater rewards. Such risks are too frightening for those living paycheck to paycheck, and any extra money is spent on more expensive essentials. Despite this, the mundane fundamentals of how to position yourself to win remain. Saving more than you spend, investing in a varied portfolio over time, not panicking, staying invested, and controlling overhead are all important. So, what are your thoughts on all this? Let us know in the comments. As always, thank you for watching, and don't forget to like and subscribe to stay up to date in the world of economics.